Welcome to the MaxDividends channel, where we help people build growing passive income, retire early, and live off dividends. Today we're examining Bank OZK, dividend-focused regional bank with credit cycle-driven earnings. We'll answer, how does this company make money? Is it good for long-term holding? We'll go through MaxDividends checklist step by step, check financial condition, see if it fits our plan, and determine if the stock is undervalued today. How this company makes money. First question, do I clearly understand how Bank OZK earns its money? And does that business model make sense for a dividend investor? Bank OZK makes money the classic bank way. It gathers funding, mainly deposits, and lends that money out, earning the spread between what it receives on loans and what it pays on deposits and other funding. That spread turns into net interest income, the core earnings engine. In recent years, management has highlighted record net interest income in the range of about $1.59 billion per year, supported by loan growth of over $2.34 billion and deposit growth of a similar size. This is a balance sheet business, not a subscription app, and not a consumer product company. The main engines are net interest income. The basic formula is simple. Loan yields minus deposit and funding costs equals net interest margin and net interest income. When deposit costs rise or loan yields compress, net interest income comes under pressure even if the bank is executing well operationally. Specialty commercial real estate lending. A big part of OZK's identity comes from its real estate specialties group, focusing on acquisition, development, and construction loans in commercial real estate. These loans can be larger and higher margin than plain vanilla lending, but they are also more cyclical. When the commercial real estate cycle turns, credit risk shows up quickly. Diversified lending platforms. OZK has been broadening beyond its specialty book with community banking, indirect lending, asset-based lending, and niches like recreational vehicle and marine loans. This helps reduce single-bucket risk, but the market still treats OZK as a credit cycle-sensitive bank. Fee income, but not a fee business. The bank earns non-interest income from service charges and other fees, but that number is small relative to net interest income. This is not an asset manager that lives on fees. It is a lender that gets paid for taking and managing credit risk. So yes, the business model is clear and straightforward. But for a dividend investor, reliability here depends far more on credit quality, funding costs, and capital discipline across the cycle than on stable consumer demand. That is a crucial distinction. Is this a good stock to buy long-term? Step 1. Dividend history. Our first filter is simple: at least 15 years of consecutive dividend growth. If a company cannot pass this, we do not dig deeper for long-term income. Bank OZK passes this test. Over the last 15 years, the dividend chart shows a clean, consistent staircase higher. In the early 2011, the annual dividend was below $0.25 per share. By the 2015, it moved above $0.50. Around 2019, the dividend crossed $1 per share. By 2024, it climbed above $1.50. And by 2025, total annual dividends reached roughly $2.18 per share. The most impressive part is the acceleration in the last 3 years. From 2023 through 2025, each annual step is noticeably larger, showing aggressive dividend growth on top of an already long streak. There are no cuts, no freezes, and no pause years in that 15-year window. Step 1 passed. Bank OZK has a genuine dividend growth habit and a long-term commitment to raising shareholder income. Step 2. 5-pillar secret formula. First pillar, sales growth. For a bank, sales means total net revenue, net interest income plus non-interest income. Over the last 10 years, Bank OZK's revenue trend is clearly up, even if it is not perfectly smooth. Back in 2016, revenue was under $1 billion, around $750 million. From 2018 to 2022, the bank went through a steady grind in the $1.2 to $1.4 billion range. Then, from 2023 onward, you see a clear step change higher. By 2025, net revenues reach a new all-time high, north of $2.8 billion. That tells us the income engine is scaling. OZK has been able to grow its balance sheet, expand net interest income, and monetize its lending platform more effectively. Sales growth past, this is not a stagnating bank. It is a bank that has grown its revenue base significantly over the decade. Second pillar, profit growth. Dividends are ultimately funded by profit, not just revenue. On the profit chart, Bank OZK also shows a clear long-term uptrend. In 2016, profit was just under $750 million. In 2020, there was a temporary dip back toward that level. A stress year, but from 2021 through 2025, profits recover and then climb to new highs. By 2025, profit is around $1.555 billion, more than double the mid-decade level. What matters is the combination. In 2025, revenue is about $2.806 billion, profit about $1.555 billion. That is more than 55% profit conversion, which is extremely efficient for a banking model. Profit growth past, Bank OZK has grown its profit base strongly and restored profitability even after a difficult year. Third pillar, net income. Net income is the cleanest bottom line for shareholders. Here the pattern is one stress dip, then a stronger plateau. In the 2016, net income was around $270 million. In 2020, net income drops sharply below $300 million, reflecting a tougher year for credit and funding conditions. But from 2021 onward, net income recovers and steadily climbs. By 2025, it sits around $715 million, and for roughly the last 3 years, it has been holding above $700 million. So while earnings are not perfectly smooth, the long-term direction is up, and the bank has demonstrated the ability to rebuild earnings power after a shock. Net income past, long-term net income has more than doubled versus the mid-2010s. Fourth pillar, dividend payout safety. Now we look at how aggressively management is using those earnings. Is the dividend taking up too much of net income, or is there a safety buffer? Over the last 10 years, Bank OZK's payout ratio has been conservative. From 2016 to 2019, payout sat roughly between 21 and 28%. In 2020, there was a temporary spike to around 47.5% as earnings dipped. Then, from 2021 through 2024, the payout ratio moved back into the 23 to 27% range. In 2025, it rises toward the low 30s, around 33.8%, and the latest reading sits near 27.5%. This is exactly what we want to see, a low to moderate payout ratio, enough room to keep raising the dividend even if earnings weaken for a year or two. Dividend payout safety past, the dividend is well covered with a real margin of safety. Fifth pillar, debt burden. Banks are different from industrials or utilities. Their liabilities are part of the product. Here we look for stability in the capital structure, not for zero debt. On the debt ratio chart, Bank OZK looks remarkably consistent. Over the last decade, the ratio sits in a tight band around 0.82 to 0.85. At the end of 2025, it is about 0.85. There is no sudden leveraging up, no visible balance sheet stress used to support growth or dividends. Debt burden past, the leverage structure is stable, with no obvious red flags. Financial score, putting all 5 pillars together, Bank OZK comes out with a financial score around 90. In our framework, that is very safe. It signals strong growth, high profitability, solid earnings stability, disciplined payout, and no obvious balance sheet danger. Step 2 passed. Bank OZK screens as a financially disciplined dividend grower built on real earnings power rather than financial engineering. Does it fit our plan? Next, we ask, what role should this stock play in a dividend portfolio? Inside MaxDividends, we use MaxRatio to combine 3 ingredients: current dividend yield, dividend growth, and financial strength. For Bank OZK, we will use a MaxRatio of 12.61 and a current dividend yield of 3.69%. with roughly 102% cumulative dividend growth over the last 5 years, a 5-year average payout ratio in the mid-20s, and a 25-year streak of consecutive dividend increases. A max ratio above 12 pushes OZK firmly into the income eagle category. In practice, that means you are getting a meaningful yield today, higher than typical growth compounders. Dividend growth has been very strong over the last cycle. The payout ratio remains low, leaving room both for increases and for absorbing hits. There is a long record of consistent increases that signals dividend policy is a real priority. Bank OZK works best as an income-first position with growth on top, a stock designed to generate real cash flow today, but still grow that cash flow aggressively if the cycle stays manageable. Is the stock undervalued today? Now, valuation. We look at 4 angles: relative to peers, relative to its own history, relative to its own yield history, and what the analysts are saying. Cheaper than competitors. On peer comparisons, OZK screens as undervalued versus other banks with similar business models. The company delivers strong earnings per share relative to its group, but trades on lower multiples. That means you are paying less per dollar of earnings than you typically pay for comparable banks. For dividend investors, that is exactly the kind of starting point we like. Strong fundamentals at a discounted price. Cheaper than its own history. Versus its own 10-year valuation history, the stock also looks inexpensive. The current price-to-earnings ratio is around 8.3 times earnings, compared with a 10-year average closer to 10.4 times. In simple terms, the market is paying fewer dollars for each dollar of OZK earnings than it usually has over the last decade. That can be either an opportunity if the fears are overdone, or a warning if credit risks are genuinely building. But in any case, it is cheaper than its historical norm. Better yield than usual. The current dividend yield of roughly 3.69% is significantly above the long-term average of about 2.47%. A higher than usual yield normally appears when the share price lags behind dividend growth, or when the market is cautious. For a dividend investor, starting from almost 4% instead of around 2.5% is a big difference in immediate cash flow, provided you trust the safety of the payout. Analyst consensus. On Wall Street, Bank OZK is not a screaming buy, but tends to sit around a neutral or mild buy rating. Average 12-month price targets cluster only moderately above the current share price, often implying high single-digit to mid-teens percentage upside. The spread between the lowest and highest targets is wide, which tells you the analyst community is split on how the credit cycle will play out. That fits our own conclusion. This is a quality bank priced with skepticism, not a boring utility where everyone agrees. Final decision. Bank OZK combines several things dividend investors like to see: a long dividend growth streak, rapid recent dividend increases, strong revenue and profit growth, a conservative payout ratio, and a stable capital structure. Financially, it earns a very safe profile in our framework. With a max ratio of 12.61 and a dividend yield of 3.69%, it clearly fits into the income eagle bucket, a stock designed to deliver meaningful income today and push that income higher at a fast pace. But it is important to classify it correctly. This is not a recession-proof utility or a consumer staple you forget about for 20 years. It is a bank. Dividend reliability here is tied to credit quality, funding costs, and the broader cycle. Used properly, Bank OZK is a paid-to-wait dividend bank. You collect solid income, backed by conservative payout and strong profitability, while the market remains cautious and you keep one eye on the credit metrics. Subscribe for more analysis. This is not investment advice.